What's up guys, it's James Allen, the Out-of-State Investor, and recently we've been seeing a huge shift taking place in the real estate market over the past few months. Price drops have been increasing, inventory has been growing, home builders are starting to get nervous, and some markets are already starting to feel the effects and starting to see initial price declines taking place. So in today's video, we're going to be talking about the 10 housing markets that are most in danger of crashing, and if you are looking to buy or sell right now, you'll definitely want to watch this video until the end to see if your market might be one of those 10 markets. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Alright guys, so as I mentioned earlier, we've been seeing a huge shift taking place in the housing market, and a big part of that has been inflation taking place. You see, going back to the pandemic, when the Federal Reserve lowered interest rates to 0% and they were buying billions of dollars of these treasuries and mortgage-backed securities, it artificially stimulated the economy and the housing market especially because it caused mortgage rates to go to these all-time lows, which then spurred on this massive demand to buy houses and brought housing prices to a record high that we haven't seen ever before. On top of that, you have these cheap interest rates making it cheap to borrow money. You have the supply chain issues and stimulus checks getting passed around that has just contributed to this massive inflation that we haven't seen in over 40 years. So now with the latest numbers, we have inflation showing an increase of 9.1% year over year. And at this point, we have a serious problem that the Federal Reserve realizes we need to tackle. Not to mention that the 9.1% number they're giving you is a pretty inaccurate number. In reality, it's much higher than that because of the methods they use to calculate these numbers, such as when it comes to rent. They determine what rent has increased by just simply asking homeowners, what would you rent out your home for if you were to do that? They're not landlords, they're not real estate agents, they're not real estate professionals in any capacity, so there's definitely a high probability that they're going to make an error in judgment when it comes to evaluating what their home is capable of being rented out for. So anyways, all that said, the Federal Reserve's number one priority right now is inflation, and so as a big part of that, they've started this quantitative tightening is what they call it, where they're basically raising these interest rates. They're basically offloading their balance sheet that they've built up over the past several years. And the reason they want to do this is to slow down the economy, which in turn combats inflation. If you were to raise interest rates, you raise the cost of borrowing money, which makes money less accessible to the average person. They're less likely to spend money on goods and services, which then in turn hurts the company's revenue, and they're less likely to raise prices because there's not that much demand to how much there was before. Well, so far we've seen the Federal Reserve raise interest rates a total of 2.25%, and in addition to that, as of June, they've started offloading their treasuries and mortgage-backed securities, which all of that combined has played a big role in mortgage interest rates going up to the heights that we've seen recently. Although it has come down recently, it's still much higher than where it was earlier in the year. So as a result of this, we have extremely high housing prices mixed with extremely high borrowing costs, making for the most unaffordable housing market we've seen since 2006, which was the last time the housing bubble popped. Now, this unaffordable housing market has priced a lot of home buyers out of the housing market, and as a result of that, we've seen housing transactions go down dramatically, and we've started to see inventory rise in several markets at an extremely fast pace. So this is a serious red flag because anybody who follows real estate understands that prices are largely dictated off of supply and demand. When supply is very high and demand is very low, you start to see price declines. And when you have demand very high and supply very low, which we've seen over the past several years, that's why we've seen this astronomical growth in house prices. So with supply growing the way it is right now, it's very likely that we could see some markets start to see some price declines on the way. So with that said, Redfin recently came out with an article of the 10 housing markets most likely to experience a downturn during this economic recession. The way they determined these housing markets was based on house price volatility, house price growth, and average debt to income ratio. So we're going to take a look at those 10 housing markets today, and starting at number 10, we got Tucson, Arizona. As far as price drops go, they were as low as 1.6% earlier in the year, but as of now, 7% of all listings are experiencing price drops drops of some kind. And then as far as supply goes, it was as low as 7.2 weeks of inventory earlier on in the year. Now they're up to 11.3 weeks of inventory, so that's starting to build up slightly. And number 9, you have Tampa, Florida. And as far as price drops go, they were as low as 3.4% earlier in the year, up to 13.8% of all listings currently experiencing price drops. As far as supply goes, it was as low as 4 weeks of inventory, now up to 9.3 weeks of inventory. So that's gone up significantly, over double the amount it was earlier in the year. And number 8, we got Phoenix, Arizona. As far as price drops go, they were earlier in the year as low as 2.3%, now up to 13.7% of all listings are experiencing a price drop of some kind. Now, as far as supply goes, Phoenix was sitting on as low as 5.4 weeks of supply, but since then it's almost tripled the amount, currently sitting on 13.7 weeks of supply. This is a huge jump that we're seeing currently in Phoenix, Arizona. At number 7, we have Bakersfield, California. Now, price drops have gone from 2.3% up to 7.3% of all listings. Supply is up from 6.3 weeks earlier in the year up to 11.5 weeks of inventory. Bakersfield, although it's ranked higher than Phoenix, honestly, I would be more concerned about Phoenix than I would be with Bakersfield. At number 6, we got Sacramento, California. Now, as far as price drops go, we're seeing over 12.5% of all listings experiencing price drops. Supply has gone from 4.2 weeks of inventory earlier on in the year up to 10.9 weeks of inventory, so close to tripling the amount of supply. At number 5, we have Las Vegas, Nevada. I've heard a lot about Las Vegas, Nevada as far as inventory seriously rising there. With price drops, we're seeing 11.6% of all listings in Las Vegas experiencing price drops. Supply was as low as 6 weeks of inventory earlier on in the year, and now it has gone up to 15.7 weeks of inventory, again close to tripling the amount of inventory it was at earlier this year. Number 4 is Northport, Florida. With price drops, we're seeing 12.2% of all listings experiencing a price drop of some kind. Supply has gone from 4 weeks of inventory up to 10.8 weeks of inventory over the past several months. And number 3, we got Cape Coral, Florida. Price drops, we're seeing 9.6% of all listings experiencing a price drop of some kind. Supply has gone up from 5.2 weeks to more than double that at 11.3 weeks of inventory. And number 2, this is definitely the worst one on the list in my opinion, but it's Boise, Idaho. As far as price drops go, get a load of this. 17.4% of all listings are experiencing price drops. That's about 1 out of every 6 houses experiencing a price drop. And then as far as supply goes, they were as low as 4.6 weeks of inventory earlier on in the year, now up to 14.5 weeks of inventory, more than triple the amount of inventory they were at earlier this year. And finally, number 1 is Riverside, California. Price drops, as far as that's concerned, 8.1% of all listings are experiencing a price drop. Supply has gone from 6.8 weeks of inventory all the way up to 13.4 weeks of inventory over the past several months. And there is one market that we need to mention that is actually not on this list that honestly is just as bad as Boise, Idaho, and may even be the market most in danger of crashing during an economic recession, and that would be Austin, Texas. As far as price drops go, 12% of all listings are experiencing a price drop of some kind, but get a load of this. The supply has gone from 6 weeks of inventory all the way up to 17.2 weeks of inventory. A huge amount of inventory has been piling on in the Austin, Texas market. Median sales price, get a load of this. At the height, it was $574,000, now down to $526,000. That's over an 8% decline in median sales price. So that is pretty significant at this point. So guys, this is what I would say. I heard about Austin, Texas. After seeing these numbers, my thoughts were right. Austin, Texas is right there with Boise, Idaho as 2 of the dangerous markets to watch out for. So if you're looking to buy a house in one of those markets, markets, you better be looking for the long term, not the short term, to be able to ride out any potential price declines in the near future. So anyways, this is a little different than what I typically do, but if you enjoyed this format, do me a favor and let me know in the comments below. And if you appreciated this video, got any value from it whatsoever, do me a favor and support the channel by smashing that like button, and also subscribe and hit that notification bell to watch more content like this. Finally, follow me on TikTok and Instagram at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.